Well, welcome to the February 2022 Real Estate Market Update. My name is Michael Bauerfein with Bauerfein Real Estate, powered by Green Tree Properties. And today we're going to be talking about three of the most important things in real estate today. So let's get to it. So today we'll be talking about home ownership as a hedge against inflation, rising mortgage rates, and the latest update that we have on forbearance. So what's so important about home ownership as a hedge against inflation? As we see prices rise for gas, groceries, and your favorite Grubhub delivery, we know that home ownership or rising rental costs are also going up. Mark Kassan of Investopia says real estate is a tangible asset which tends to hold its value when inflation reigns. As prices rise, so do property values. Most of you homeowners know about this. Some of you who don't own a home may not. So this chart goes all the way back to the 1970s for more than 50 years. And you can see back in the 1970s, the inflation rate was at 7.1 and the home price appreciation was just under 10%. In the 80s, however, it was pretty even. The 1990s, real estate took the lead. And in the 2000s, as we know, was a completely different decade. But home price appreciation took over again in the 2010s. As we know, 2020, we had low inflation. And 9.2% in home price appreciation. Last year, ridiculous, almost 20% appreciation in 48 out of the 50 states. But you can see inflation crept up. It's also interesting that as we discuss inflation, we need to look back all the way to the 70s. It's a valuable reminder that over the past 50 years, rents generally increased greater than inflation. The blue line is the inflation rate. The green line is rental appreciation. And if you follow this line, you can see far more green above the blue line, meaning rents over the last 50 years have exceeded inflation. Natalie Campisi of Forbes writes, homeowners are shielded from mounting rental prices because their cost is fixed. Regardless of what's happening in the market, tangible assets like real estate get more valuable over time. Buying a home, if you can afford it, is a good way to spend your money during inflationary times like these. We've talked about home price appreciation, but where are we heading? The Home Price Expectation Survey is a survey of 100 economists and data analysts who forecast home price appreciation in a 5-year period. This forecast that we're going to look at was from Q4 2021, and optimists are in the green, and they are predicting a 62.5% increase over 5 years. That's just a little over 12.5%. The pessimists are predicting a 23.7% increase, which is just under 5%. All those numbers are good. So regardless of if you're an optimist or a pessimist, prices are going up. Here are the Orange County listings inventory versus demand statistics since 2004. Throughout almost all of these periods, inventory was higher than demand, especially during the mortgage crisis, as you can see. Big time, a lot more inventory than there was demand. But as you can see, demand currently exceeds listings inventory. Shocking. This slide shows the active listings inventory for the past 4 years. And as you can see for 2022, it's about 16% of what it was in 2019. In 2019, we had 6,000 homes on the market at the start of the year. Then it went to 4,000 in 2020. Last year we had 3,000, and this year we have just over 1,000 homes available for sale. If you think there's nothing to buy, well, you're right. As you can see, when we discuss inflation, it's really important that we go back decades. It's not sufficient to just look at year-over-year changes. Many of my younger clients have never experienced high inflation or a serious correction in the real estate or the financial markets. And I certainly cannot predict what's going to happen in the future. But it does seem like we're heading in a new direction in the financial environment. And it's my job as your agent, it's our job as your real estate team to keep you informed of all of these changes in the real estate and financial markets, and to communicate these changes to you to maximize your returns on real estate that you intend to buy or to sell, or in which you intend to invest. Sam Katner from Freddie Mac says mortgage rates remain unchanged from last week. As the economic recovery continues, mortgage rates are expected to resume their upward trajectory. Mortgage rates are currently at about 3.55%, and this is on the average 30-year fixed mortgage. Freddie Mac and experts believe we're going to see some higher rates, and that's what we need to be prepared for. This graphic goes all the way to the start of 2020, which is right before the pandemic, where rates were at 3.7%. Well, what do you know? Higher than they are today. How about that? So we're back in the area where we started when the pandemic came on us just a little over 2 years ago. You go back 4 years to the beginning of 2018, and you take that same 3.55% mortgage that we have today, you can see we are actually doing much, but it's a much more competitive rate now than it was even 3 or 4 years ago when it was very, very close to 5%. Freddie Mac also says as mortgage rates rise, we expect some moderation in housing demand. Obviously, if prices go up, demand goes down. And this is going to cause house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the house market competitive. Well, check this out. They go on to say that in 2022, they still expect purchase originations to grow from 1.6 trillion to 2.1 trillion in 2022. That's this year. Conversely, they expect refinance activity to decrease from 2.7 trillion to almost 1.2 trillion. That's almost 50% decrease in refinances. So why is this important? Well, in the past 2 years, most people have been able to lock in historically low rates, and good for them, good for gay homeowners. That's what we're supposed to do. However, if refinancing shrinks by 50%, you may see headlines that talk about how the overall mortgage market is also constricting. But remember what Freddie Mac is saying, the purchase market, new loans are predicted to grow, and we realtors will be ready to help you buy, sell, or invest when you are ready. Don't look at the headlines. Give us a call. You take that rate of 3.55% and even going up to a little over it to 4%, it's still a good rate. Go back another 50 years, go back to the 70s when it was just under 9%, or the 80s when it was just under 13%, and 8 and 6. And now we are at 3.55 and maybe, looking at 4 or 5. It's still pretty good mortgage rate. It's pretty good use of your money. I'm often asked about interest rates and where they're headed. Well, if you want a better idea of where rates are going, follow the 10-year Treasury yield. And let's go back 50 years. The relationship between the mortgage rate and the 10-year Treasury, so the 10-year Treasury is the blue line, the mortgage rate is the green line, is almost symbiotic. Look at the distance, meaning when the Treasury goes up, guess what? So goes up the mortgage rate and vice versa. Oh, look at how they've been pressing us down here just to the middle of 2021 when we needed them with the lowest rates in history. This is what the Federal Reserve has recently done. They've taken them up, and guess what's probably going to be next? I'm just saying. Hey, the last topic we're going to talk through today is forbearance. Let's begin with an update on how many loans are in the forbearance program. Loans in forbearance have fallen to roughly 780,000 in January of 2022. And if you think about where we started, way over in the red bars, where you had 5 million homes in forbearance, and we're down to 780,000. That's a pretty good. That's pretty good. Andy Walden of Black Knight Data says, as the COVID pandemic continues to create uncertainty in the global economy, the overwhelming majority of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. So this is great news on the efforts put forth by everybody to help get people back on their feet. So this is a picture of the loans that exited the forbearance program. The green section, about 38%, are all paid in full. The blue section represents 43.7% who have done workouts or repayment plans where they received a loan modification or a deferral. And so overall, 80% of the people who went into the forbearance program are out. This is a tremendous accomplishment. The percentage of homeowners that are still in trouble are about 18.2%. And these homeowners do not have a loss mitigation plan. Black Knight reports that these homeowners in the entire program had at least 10% equity. So that means that if you got equity, you also have the opportunity to potentially sell your home rather than to go into foreclosure. So if you or anyone you know is in the situation where they still have equity, but they need to make a change, we have them call me. We would be happy to meet with them, analyze their options, and recommend the best strategy for moving forward. This is what we do. So let's look at the number on the right side of the screen in 2021. This is the number of foreclosures currently active of only 151,000. That is an all-time low. And, we never want any homeowner to go through the foreclosure process. We believe in homeownership and the value of what it brings to everyone. But look at those red bars, 2007 and 2015, where millions of homeowners were going into the foreclosure process. You can see this is vastly different than where we are today. And even if this number of 151,000 doubles or triples or quadruples, we're nowhere near where we were when the housing market burst in 2008. So this is not then. Finally, McClare Bolton Smith of CoreLogic says, we may see a little bit of an uptick in foreclosure rates in 2022, but just an uptick from an extraordinarily low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low, which is good news. Well, that's it. That's the February 2022 real estate market update, and I appreciate you taking the time to watch. As always, the content is provided by Keeping Current Matters and Reports on Housing. I produced, directed, and edited this program. Please hit like if you enjoyed it, and subscribe if you have the opportunity, and a button, and I'll keep you up to date on all the videos that I'm producing. As always, please call if I can help in any way, and may peace and love abound with you today. See you next time.